Welcome everyone to our live stream. We'll get started here in just a few more minutes. We will get started in just a few more minutes. Please stand by. Okay, let's see. There we go. Good afternoon, everyone. We are so happy to see you back for our 1 p.m. presentation. This, of course, is our second week of our virtual Discovery Festival. My name is Will Tapia, and I am the Advancement Coordinator for Big Brothers Big Sisters of Central New Mexico. And I am so happy that you are all here. Again, this is the second week of our virtual Discovery Festival. Normally, outside of a pandemic, this event is a one-day event at the Albuquerque Convention Center. We have 3,000 students from all across Central New Mexico. We have 50 plus exhibitors. It's a huge event. It's a lot of fun. Our exhibitors love it. The students love it. And of course, it is a STEAM exhibit. Of course, that is science, technology, engineering, art, and mathematics. So that's what this event is entirely about. A lot of our teachers from the outset asked us to continue this event into this unprecedented, strange, difficult year that we all find ourselves in, because the kids really enjoy it, we really enjoy it, and the exhibitors really enjoy it. And so that's what we're doing here. But instead of a one-day event, we're doing a 3-week long event with live streams from different exhibitors every single day. So this is awesome. Again, we're so happy that that you're here on the stream. I want to lay out a couple of ground rules. So if anything happens, if the stream goes down, I don't think it will, but just in case, if we have any kind of technical issues, just go right back to this YouTube channel. That's BBBS CNM, Big Brothers Big Sisters of Central New Mexico, BBBS CNM. Go right back to that YouTube channel and you'll be able to recover the stream. We'll have it back up really, momentarily if there's issues with it. Again, I don't think there will be, but you never know with technology, right? That being said, I do want to give a quick shout out here to some of our amazing sponsors. We have some truly fantastic sponsors. That's not the right slide, but this is the right slide. Big shout out to our Da Vinci presenting sponsor, Honeywell. Honeywell has been a partner of ours for many years. They're wonderful, wonderful folks over there. And they're presenting tomorrow. So stay tuned for Honeywell's presentation. I believe that's at 2 p.m. 2 p.m. tomorrow. You can, of course, check the virtual exhibit hall, and we'll have their information up there hopefully by the end of today. But all your teachers have received the live stream link already for this presentation tomorrow. So check it out and stay tuned. Our curious sponsor, hey, this is who we're having on today, Fidelity Investments. Thank you so much, Fidelity, for your sponsorship. Fidelity has been a community partner of ours for many years. They are always a huge hit at the convention center. They have multiple tables, exhibits going on. They are a huge blast. And of course, they'll be on today momentarily to talk a little bit about what is credit. So thank you so much, Fidelity, for your sponsorship. To our ride sponsors, to Aztec Machine and Repair out in beautiful Bloomfield, New Mexico. Aztec does our amazing awards every single year for this event. So thank you, Aztec, for that. To Air Force Research Laboratories, AFRL, they're going to be on next Tuesday, the 17th. I believe that's the 17th, to talk about satellites. They are going to be doing a very neat satellite demonstration. So thank you so much, AFRL. To our Newton sponsors, the Defense Threat Reduction Agency, Micronet Solutions, Sandia National Laboratories, and Presbyterian Hospitals. Thank you all so much for your sponsorship. Okay, now let me get out of that screen here. Okay, there we go, and I'm back. I think that is pretty much it. I should mention also that I see some of you are already using the chat function wherever you're streaming it. That's awesome. So if you're watching on YouTube, we have a live chat going there. So if you have any questions at any point during this presentation for our exhibitors, please drop a comment there and I will ask those questions live on air. Definitely encourage you to do that. I know that the exhibitors have some questions that they're going to be asking you and are hoping for a little bit of engagement there. So please use that and I will interrupt and read it on air. Tell us where you're from, where you're watching from in your school, and I'll give you guys a shout out as well on the stream. That's all I have. I'd like to introduce, in that case, our exhibitor for today's presentation, Fidelity Investments. We have Olivia and Cedric from Fidelity. Hey, Olivia, I see you. And looks like, oh, awesome. We got Cedric there as well. How are you guys doing?
Doing well. How are you?
Awesome. Really, really, really well. Welcome to the live stream. I think the kids are really sick of hearing me talking so much already. So I'm just going to turn it over to you guys. And like I said, students, please use that chat function and I will ask your question on air. All right, guys.
Well, awesome. We appreciate that, Will. So how's everyone doing? My name is Cedric. And
hi, I'm Olivia, and we're with Fidelity Investments. We're happy to be here with everyone today.
Yeah, so let's go ahead and jump into it. Let's pull up our little PowerPoint that we have here. And so today we'll be talking about what is credit. And so for those who don't know, this will be a nice learning experience. And for those of you who do know what credit is, hopefully this will increase your knowledge on that. So let's go ahead and jump into it. And so this will be a little overview of what we'll be covering. We do have an icebreaker that we want to go ahead and go over with you guys just to have some fun. Hopefully you guys interact with us on that. We'll discuss some vocab terms. We'll really discuss what is credit, the advantages, disadvantages between it. And then we also have another activity that we'll go ahead and work on later on. And we'll wrap it up. So let's go ahead and get started. So just a quick introduction. My name is Cedric Robinson. I've been with Fidelity for about 1.5 years now, a little over. And I really just want to thank each and one of you who all decided to come and be a part of this event today. I know that this is something I really wish I had in school when I was your age, because this stuff is so important, especially when you start getting older and becoming an actual adult. So I really hope that all of you take advantage of this opportunity, because I promise, your 24, 25-year-old self will definitely thank you for it. So.
Thank you. I'm Olivia Gutierrez. I've been with Fidelity for almost 5 years. And like Cedric mentioned, this is a great opportunity. I wish I had this in school. I know we had talked earlier, and the only financial education I remember receiving when I was in school was one session in economics my senior year. So I really wish I had more information going into my adult life, but we're happy to be here with you today and can't wait to, give you a little bit more information. And if you're ever interested, there's so many resources out there for you to utilize as well.
Yeah.
So
awesome.
I think we'll jump into our activity. And that is going to be, if you can have any superpower, what would it be? Because we all want to be superheroes.
Right. And so, if I'll go ahead and start. I think my superpower, if I had to choose, Olivia, it would, be having the Avatar's powers. I don't know if you're familiar with who that is, but he has, so he gets to control 4 different elements, which, I think it's kind of cheating because it's more than just having one superpower there. So that would have to be my go-to.
I've actually never heard that answer before, so that's a great answer. My go-to would probably be flying. I just think it would be so cool to be able to fly and just kind of go wherever. I don't know. I don't really even know what you can do with that type of superpower, but it would be fun.
So we did get some comments here. So we got some who said flying as well. So that was a good one. Nice. I think the Superman illustration inspired some thoughts there,
Yes, we can all fly together.
We also got invisibility. That's a good one.
Oh, that is a good one.
Yeah.
Invisibility and and Harry Potter. So.
Hey, that's always a good superpower.
Yeah.
I wish I could do magic.
That's kind of like cheating like Cedric's, I would say. You get more than one power with that.
Right?
Exactly.
Those are awesome answers. Well, thank you.
Yeah, thanks for sharing. Really appreciate it. So we'll go ahead and go on to our next activity here, and that's going to be vocabulary review. And so just to go over some of the definitions whenever it comes to what you have to deal with whenever it comes to credit, I mean, there's a few different ones. So, I mean, really, let's start off with credit. And so credit is the ability of a customer to obtain goods or services before payment. And that's going to be based on, oops, sorry, guys. And that's going to be based on by the lender, and that's going to be provided by them and based on the trust that you are going to be paying that back to them in the future, plus probably some additional funds.
And in kind of the opposite of credit is debit. So that's a payment made or owed. But debit is something that you don't pay for in the future. You're paying it right then and there. So it's using cash, using your debit card. It's the money is gone as soon as you purchase something.
Then the next one that we have is interest. Interest is a really big thing, especially when it comes to credit, because that really kind of determines what you're going to be paying back. But interest is the price a borrower pays to a lender for the use of the credit and provided by the lender. Interest is the reward lenders receive for allowing others to use their funds. So just a quick example, let's say that you borrowed $10, but you have to pay $15 back in a week. That's that interest portion there.
And there is always risk with using credit. So risk is the possibility of financial loss. There are ways to misuse credit, and we're going to talk about that later on in the presentation, but that's where the risk comes from.
Mm-hmm. Next one is credit score. Another big thing that people look at whenever it comes to applying for credit. Basically what your credit score is, it's just a number assigned to a person that indicates to lenders their capacity to repay a loan. So the higher the credit score, the more it's likely you're going to pay your bills. The lower the credit score, the more likely you're not able to pay those bills.
And then you did mention lenders in that last definition. So the lender is an organization or person that actually lends money.
Yep. Then we have assets. Assets are goods or services that usually retain or increase their value.
And this can be anything from like a home or a college degree. Those are assets that increase their value over time.
Mm-hmm.
And then a loan is a thing that is borrowed, especially a sum of money that is expected to be paid back with interest. So that goes hand in hand with credit.
We have a few examples that we'll get into as well later on. And then last but not least, we have collateral, which is pretty similar to assets. It's an asset used to back a loan, but probably won't get into too much detail regarding collateral today. But that's just a brief overview of most of the definitions that you want to be familiar with, especially when it comes to you applying for credit or using your credit. Okay. And also feel free, if you guys have questions, be more than happy to hear any of your questions while we're going through the presentation. So please throw some questions out there if you have any. But we'll go ahead and go on to the next slide here. And so we'll discuss basically what credit is in a little more detail. So credit is obtaining the use of money that you don't have at the end of the day. Think about it as you ask your friend to borrow, $5, okay, and you pay them back a week later with $7. That's basically what credit is. But with credit, you obtain the money from a number of financial institutions in most cases. And in that case of you applying for credit, you have to convince the institution to loan you the money. In return, you pay the borrowed amount back plus some additional interest. Okay. Now, there's really going to be two ways to make purchases, as we kind of went into when we were going over vocab. There's debit and credit. Now, in most cases, and Olivia, tell me if I'm wrong, you want to try using your debit card or debit to make most of your purchases if you can. Now, again, there are times, credit is going to be a big factor that you can use if you need to buy something that you just don't have the funds for out of pocket at this point in time. Credit could be great for that type of purchase. That way you can, get what you need now, but make payments on it while you're using that item. And there's really some benefits too. I mean, credit is expected to benefit both parties that use that option. I mean, for borrowers such as ourselves, the people applying for the credit, it's going to allow us to, again, get the item that we want now and pay for it in the future. So that's, how it's benefiting us. For the lender, the person that's loaning the money, it really gives them the fact that you're going to repay them that principal amount that you borrowed. Plus, you're also going to give them some interest, which is a little additional amount on top of you letting you borrow that money.
Yeah, so overall, credit, when used correctly, is a very good thing for both sides. It should truly be a win-win situation for both the borrower and the lender. The caveat is when it's used correctly.
All right. Yeah, that's very important. And so let's go ahead and go on to our next, and we'll talk about, why credit and how we can get it.
We did have a question come up. You were mentioning the a debit card. And so this question pertains to using a debit card and how sometimes, it'll say, do you want debit or credit? But it's a debit card. How does that work if it's a credit card? I mean, if it's a debit card, sorry, if that makes sense.
Yeah. Olivia?
That is a great question. I am actually not sure how that works when it's a debit card and you use credit. Cedric, do you know?
Well, yeah, so I wouldn't, great question for someone that handles banks, but I'm going to say that, to the best of my knowledge, whenever it's a debit card, it's strictly a debit card. Regardless if you do run it as credit or debit, really it's going to take the money out of your account as debit.
And I believe it has to do with the timing of when the funds are pulled from your account. As far as the credit goes, yeah. I think it pulls the funds a few days later. I don't think it's immediately.
Yeah.
Okay. Awesome.
Great question, though. Now I want to learn more on that.
Another question that came in was, why would you need to use credit?
Yeah. So, I mean, there's a lot of different reasons that you would want to use credit for. The main thing is, it's more of if you need something. Again, that's the key word, is need instead of want, because we all want things, right? But it's more as if you need something right now that you don't have the money to pay for. And so credit will allow you to buy that thing that you need, and you can make payments on it in the future. Okay. And again, need is that big word there.
Yeah, especially for those big ticket items, like a house or a car. A lot of people, I mean, the majority of people probably do not have the cash on hand to pay for a car in full. So credit is definitely something that we need to use for those big ticket items as well. But that is a good segue into our next slide. Actually, we're going to talk about why we want to use credit. So people obtain loans to buy cars, homes, major appliances, college education. They take out loans to improve their homes. So those are all reasons why we may need to use credit. There's many more as well. Sometimes there's emergencies and you may not have emergency savings, which is important to have, but sometimes you don't. So having credit can help someone in an emergency who needs to pay off medical bills or something like that. So those are all reasons why we could actually need to use credit. And there are sources of credits, commercial banks, savings and loans, credit unions, and consumer finance companies. So those are the companies like Discover, the people, Chase, the people that give out credit cards, and you use credit cards to purchase things as well. So when you take out a loan, the owners of these financial institutions expect to be compensated for actually lending you their money. This is where the interest is implied, as we had discussed earlier. And then the interest is the price we pay as a borrower to a lender, which is one of these sources of credit. So like we'll pay it to a bank, say if we take out a mortgage for a home. The borrower is the person who's buying the home, and then the bank is the lender, and they're who are paying the principal amount, the amount we borrowed, and the interest, the amount it costs us to borrow the money to buy the home. And again, interest is kind of like the reward to the bank for lending you that money. And we did mention interest earlier, but an important factor in determining the rate of interest to be charged is the amount of confidence that a lender has in you, the borrower. So that's where the credit score comes in handy. You know, when you have a high credit score, the people lending you money, these banks and savings and loan places, the credit unions, they're going to be more willing to lend you money at different interest rates. And yeah, so do we have any questions? I want to pause here because I know that's a lot to go over as far as, you know, sources of credits, things we can use credit on.
We did get a question come in just now asking, why would you use credit if you could just buy things with cash?
Well, let's see. You can use credit for a lot of different reasons. I think best practice is if you can buy with cash, that may be the best option, you know, to use the cash before using credit. Again, because you don't want to get yourself into a situation where you've maxed out your credit and then you're not able to pay it back. Sometimes when you have credit, it's easy to continue buying without realizing, hey, you have to pay it back. Now it actually costs more because you're also paying the interest.
Mm-hmm. Well, and as you're saying on that, right? I mean, exactly as if, you know, if you're buying like a new TV for $100 and you have cash and $100 and you can do that, awesome. But then if you buy it on credit, you know, maybe that's only like $20 every couple of weeks or whatever. But then at the end, you end up paying like 120, for example, right? So it doesn't feel as hard of a hit in the beginning, but in the end, you kind of end up paying a little bit more, right?
Exactly.
Yes, you're paying almost for the convenience to buy it now. But I would say if you have the cash, definitely go with the cash. It's a little harder to spend more when, you know, your cash is gone. You can't spend anything. It's like when you have a $20 bill in your wallet, when that $20 bill is gone, you feel that it's gone. You know that you're not able to spend any more money. And credit is a little different because it's harder to see that money going away.
Yeah, since especially you're just borrowing the funds.
Exactly. But that brings us to the advantages and disadvantages of credit, which is our next slide here. So the advantages are that credit can help you acquire valuable assets, like college education or a home. These are assets that actually appreciate over time. And, you know, you can buy a home for a certain amount now, but in the future, it can be worth more. And they accumulate their values over time. So those are great reasons why people use credit, because like I mentioned earlier, I don't think anyone has, you know, $100,000 cash to put down on a home. If you do, that's great, but I don't know that many people who actually have that amount of money to buy a home out of pocket. So in a way, it can help people buy, just like add to their enjoyment of life. People can buy what they want now while paying for it in the future. And like I mentioned earlier, it can also help with emergencies. If you don't have a savings fund, if you have that credit to kind of fall back on to help you out of a sticky situation, you know, sometimes you just need to use it and it'll be available for you at that time. As long as you pay it back, you know, it would be a saving grace.
Yeah, and just to kind of top off that with the advantages and the emergencies piece, just to give you like a real life example. I mean, for instance, like 3-4 years ago, I had to buy new tires. I don't know if you guys ever had to buy tires, but tires are not cheap to buy, especially 4 of them.
They aren't.
And so, luckily I went into a dealership that sells tires and I was able to apply for a card with them. And it's something I really needed that I just didn't have the cash to pay for in hand. So that really helped me out because one, I had new tires on my car, so I didn't have to worry about old tires and, me getting in an accident because of that. And I had the comfort that knowing that I can pay this back over time. And so that was something that really helped me out. And again, that's just to give you more of a real life example of how it can help in emergency.
Yeah, thank you for that.
Yeah. But as she mentioned, definitely there's some disadvantages as well. It can definitely lead you to go into debt. That's probably one of the biggest things. Especially coming right out of high school, going into college, that's kind of around that time you get to start applying for your first credit card. And it's a cool feeling getting one, but you're also spending a lot of money that you probably don't have at that time, and that's why you're using that card. And so it always remember that you're paying that amount back plus some additional funds. So that's one big thing there. Definitely can lead to debt. Then another disadvantage when it comes to credit is that you're using your money that you're making now to pay for purchases that you've made in the past. Okay, and those are where the payments come into play. And then one of the biggest things as well is definitely missed payments. Missed payments are really huge when it comes to your paying off your credit. They can always lead to serious negative consequences. The biggest piece is if you're not making your payments, it's going to make it harder for you to apply for another loan or another credit card from another institution if they're seeing that you're not making those payments on a consistent basis. And then two, it also hurts your credit score, which your credit score is a very key component of actually applying for credit or getting a loan, especially in those the major ticket items that you need to get, such as a car or a house. So those are definitely some big disadvantages when it comes to taking out credit or having credit cards or loans.
Another negative consequence is also fees. Sometimes fees can be $35 for a late fee, and that could be more than your minimum payment. So you really got to remember that credit cards and other types of loans, but like credit cards especially, you got to be careful when you do apply for those because they will get you on all those little fees and incidents that you're missing on payments. Those can be where the situation gets really bad and just lead you to debt at that point. They can really snowball. So you got to be careful and you got to know how to use the credit card correctly, use your credit correctly, and then you'll be able to experience the advantages without any of the disadvantages.
And I promise you, when I first got my credit card, I thought I was on top of the world. And when that first bill came in, I was like, oh, I have to pay this back, huh? And so, yeah, it probably wasn't the best idea of just me kind of running up the limit. And I've learned from my mistakes. So hopefully you guys don't have to go through that. Learn from my mistakes. So you guys don't have to go through that issue. But yeah, no, there's definitely advantages and disadvantages to credit for sure. Again, if you guys have questions, along the way, please be throwing them out there. But
yeah, so we have a couple of questions that came in. I know you touched on this, I think, in the last couple of slides, but one student was asking for a clarification again of just of what is that credit score within credit that you're speaking about now?
Yeah. So when it comes to credit score, it's a minimum of 300 and a max of 850. And so that's where your score will range between. Really, credit score is a way that when you apply for credit at an institution, they'll basically look at what your score is and say, okay, well, his score is a 700, which again, our max is 850 or 800. I'm sorry. And so, if you're pretty close to the highest credit score that you can get, they're going to look at you like, oh, well, it seems like he makes his payments or she makes her payments on time. And we're more willing to, one, loan you the money that you want. And then two, we're also going to give you a lower interest rate than we would give someone with a 400 credit score. So you're not paying back as much on top of what you borrowed. So that's a big component of what credit score is.
Yeah, it's almost a way for people to get a sense of the borrower. So, if you're on the low end, you're not a very good borrower. You've been late on payments. You've, maxed out your cards. You're not repaying on time. In the middle, you're a good borrower. They can trust you. If you're towards the top, you're a very good borrower and they want to lend you the money.
And just to add to that real quickly, just so you guys can make it more real life, think about it as your report card grades. You have A to F. If you have an A, that means, you're doing great work and your teachers are more willing to work with you if you have a late assignment or something like that. Or if you have like a lower score, like a D or an F, then maybe your teacher might force you to do extra work, but they're not willing to budge on late assignments or anything like that. So hopefully that kind of helps bring it more real life.
Yeah. I think that's great. And so in that same vein, so you were talking about interest. So one question is asking, why do I have to pay interest?
So interest is the reason lenders are willing to lend you money, because they're not going to give you money if they're just going to get the same amount back. They want to get interest because it's kind of like a fee for them lending you the money now, because in the future they're going to be out of that money. If they lend it to you, they don't have that money, so they need to get like a reward for lending it to you. So that's where interest comes in. It's like their reward or their fee for giving you the money now. I hope that makes sense. I don't know how to put this into a real world example right now. Cedric, do you have a good one?
No, yeah, I think that does make sense, right? I mean, it's the bank is a business, and as a business, its product that it's selling you is that cash, right? In a certain way, and so they want that money to make money, essentially, right? If I'm understanding it correctly.
Yeah.
And and sorry, we got a couple of questions come in, so So first up, what is debt, and then is all debt bad?
No, all debt is definitely not bad. I don't know if anyone has heard this term, but I'm going to use college education as an example of good debt, because I went to college and I had to take out student loans. I'm still paying on those loans, but I don't consider it as bad debt because first off, I'm, paying them off every month. And then also I was able to get a good job because I actually had my degree. It helps me in my career now. It'll help me in my career in the future because I do have that degree that I can speak to. And one of the reasons I have that is because I took out a student loan in order to pay for school. So that's an example of good debt.
And yeah, just to add on to that, I would definitely say, when it comes to you determining if it's going to be a good debt or a bad debt, ask yourself, will this benefit me just right now or a week from now? Cool. That may be bad debt. But if you're asking yourself, will this benefit me 5 years from now or, in the future, sometime in the future, then that might be good debt, such as student loans, for instance. Again, that's more something that's benefiting in the future compared to you maybe buying a video game on credit. Yeah, you're going to play the game for some time, but after some time, you're probably going to get bored of that video game, but you're still making payments on it.
Great. Thank you. Thank you both for that answer. And then the last one that I have here that just came in was, how do you get a better credit score?
It takes time, I think, I'll start with just saying it takes time to get a good credit score, but it can be really simple. It can be paying your bill every month on time. Don't pay it late, pay it every month. And then another way is to pay the balance of your credit card bill. So don't only pay the minimum. Say you bought something for $100 and your minimum payment is only $20. If you have the funds and if you're able to, pay off the full bill every month. So that way you're not carrying a balance over month after month. It not only helps with you and like the interest that accrues on that dollar amount, but it shows the borrower, like the bank or the credit card company, whoever you're borrowing the money from, it shows that you're a good borrower. You pay back, but you don't only pay the minimum. You're actually paying back your full credit balance. So those are a couple simple ways to, raise your credit score.
Yeah, I would definitely say those are some of the key things when it comes to raising your score. Is just making on-time payments. If you can make more than the minimum, and then yeah, of course, if you can pay it off early, that's even better. There's also information such as you don't want to use more than 30% of your available credit. So if you have $1,000 available as credit, you only want to use at least $300 of that. And I mean, there's a lot of different ways that you can increase your credit score. But definitely what Olivia went over, key pieces there.
Yeah, those are monthly things that I think you can do. Another factor of the credit score is even how long you've had credit. So I know when I was going like out of high school, getting my first credit card, it wasn't even a credit card. It was to buy a laptop. So I guess it was kind of a store credit at Best Buy, but it was to buy a laptop, but I had to make payments on that. And that helped with my credit. First of all, because I'm opening credit, our lenders aren't very likely to let someone borrow something if there's no history on the borrower. And credit history is a factor in determining your score. So if you can have a credit card, pay it off, pay off the balance if possible. But if you have that card for a long period of time, that also helps because it shows that you're, loyal, that you're a good patron. So those are
Awesome.
just a few ways.
Yeah, for sure. So we're going to go ahead and actually move on to the next slide. That way we can kind of interact with you guys a little more. I'm really curious on to hear, what would you guys use credit to buy? And there's no wrong answer, of course. So, feel free to just throw anything out there. I'm just really curious to figure out, again, what you guys would potentially use your credit card or a loan for when it comes to purchases. Just to give you an example, I recently just got a new card kind of in the middle of this year, and I had to take out a car loan. So I used my credit score and applied for that loan and was able to walk away with a new car. So that's something I wouldn't mind using credit for. Olivia, did you have anything?
I know I said I got student loans, so that was probably the most money I've ever borrowed. But then I also did buy a laptop for college, so that was another one that I used credit on.
Cool.
Will, do we have any responses?
Yeah, so we got a couple responses. So it's funny because on Tuesday with Fidelity, we were talking about what the kids want to buy and what they want to save up for. And of course, the big thing that's all in the news now are the different gaming consoles. So it still holds true for this. So we got some responses for the Xbox. We got the PS5, the brand new PS5, a car. So I'm glad you mentioned that, Cedric. A plane ticket. That's okay. Yeah, I guess right now, right during the COVID-19, you get a what is it, more affordable plane ticket, I guess, right? So
yeah,
vacations are a good.
Exactly.
That's a good idea. I'm pretty sure we're all wanting one right now.
Vacation, and then a student mentioned college as well.
Nice. And that's actually I'm glad someone even said plane ticket, because what's cool about some credit cards, actually, they'll reward you for using their credit card. When it comes to certain purchases, you actually can get rewards or cash back for using it for air flies or airfare. So, I mean, that's pretty cool. And, that's something we haven't gone over yet, is that there's multiple types of credit cards that can benefit you in different ways. And that's always something that you want to look into before you apply for that card, is how can this benefit me? Is it just more than me getting the money to use? Are there other benefits with it, such as, rewards or cashback options? So I'm glad someone brought that up. That's awesome.
Yeah, that was a great point.
Awesome.
And I know someone mentioned the PS5. So in our next activity, we are actually going to cover interest to kind of show everyone how it works, how interest works, and to calculate what you'll actually be paying for this. So say we're going to use a credit card to buy the new PS5. We only have $100 of cash on hand, and I don't actually know how much the PS5 costs, but we're saying it costs $1,000.
For this whole setup, we'll say 1,000.
Yes. And then the interest rate of the credit card, we're going to say is 24%, because credit card interest is different than, say, like a home loan, mortgage, or like a car loan. It's a little bit higher. So we're going with 24%, and we're going to pay it off over 2 years. Awesome. So Cedric is pulling up the calculator here.
So let's go ahead and plug in some numbers. So again, principal amount will be at 1,000, right? Let's say that we, decided not to use our $100 on hand and not put a down payment.
So this is where, from the previous question, where someone asked, if we have cash, do we use the cash? We're going to use this example as we're not going to use any of our cash right now. We're going to pay all of it on the credit card.
And so again, we'll have our loan term for 2 years, right? So 24 months. And we decided our interest rate is 24%, which is kind of high. So let's go ahead and run a calculation. Again, don't worry about the monthly payment. We're not too worried about that, but just to kind of give you an idea of how much you're really spending.
So you bought it for $1,000, so you're automatically spending that much. But the interest you're going to be paying is going to be $268.91. That's added to the $1,000. So that means your total that the PS5 cost you would be $1,268.91.
Mm-hmm.
And that's where it comes down to, is it worth buying now on credit? Because eventually you're going to be paying more than $1,000 for that console. Exactly.
It's cool. And again, if you guys have questions during, while we're running these calculations, do not hesitate to throw those out there. Definitely want to hear you guys' questions. But we'll go ahead and go on to the next one, just to run another example. So our next one, let's say we want to buy a car, because, I promise you most likely will need a loan to take out one of these cars. So for this one, we have cash on hand. We have $5,000. Principal amount, we have, the car's $50,000. We're looking at a brand new car here. Now, interest rate on a car loan, we're probably looking around 10%, which is not too bad of an interest rate. And then the loan term, we're probably going to take this one out for 4 years. So let's go ahead and bring up our calculator again here. And let's see what we have. So now in this situation, when it comes to a car payment, most likely you do want to put a down payment. One, that just means that you're going to have lower payments whenever you actually are making the payment. Instead of paying off the $50,000, you're only paying $45,000. So let's assume, in this situation, that we went ahead and put the $5,000 down. So instead of $50,000 as our principal amount, we're only taking a loan out for $45,000. Now, for this one, again, we're looking at 4 years, which is equal to 24 months. And our interest rate will only be 10%. So again, not too crazy there. So this is how much it's going to come out to for us. So our principal amount, again, is $45,000, right? And then we have the interest rate of 10%, which adds $9,738.18. So
it's almost $10,000 in interest. Wow.
Right, exactly. So, $45,000 plus the $9,783.18. That means instead of paying just $50,000, you're paying a total of $54,783.18. So, see how the interest can add up the longer you have this loan out for. Cool.
And also, could you imagine if we had put the full $50,000 on credit instead of putting that $5,000 down?
Yeah, let's even look at that. So let's say that we took out, just the $50,000 instead. Still have 4 years to pay it off, but this time you're paying actually $10,870.20 in interest. So now instead of paying, I believe it was 57 that we were looking at, you're now paying $60,000 for this $50,000 or $50,000 loan or car. So down payments can really be helpful in certain situations.
Yes. And that brings us to our last example of purchasing a home. I'm sure everyone is excited to purchase their first home. And in order to do that, you actually take out what's called a mortgage.
Mhm.
And so for homes, it is recommended to have a larger down payment. It's typically about, is it like 10 to 15% of the principal amount that they suggest you put down?
Mm-hmm.
So for this example, we're going to say you're buying a $200,000 house. You have $15,000 as your cash on hand or down payment. And the interest rate, because it's a mortgage, interest rates are typically lower. You're not going to see like the 10, 24% interest rate. We're using the example of 4.2. And then loan terms are also longer. So you're not going to be paying off your home in only 4 years. It's going to be, sometimes people do it in 15. A lot of the times it's a 30-year mortgage. So we're going to use a 30-year example.
Cool. So let me go ahead and pull up the calculator here so we can run some calculations and let's see what we come up with. So this one, again, we put down 15,000. So that means instead of, taking out a loan for full or the mortgage for the full 200, we'll take out a mortgage for $185,000. Okay. Again, we're looking at a 30-year time frame for this. So 360 months. We're going to look at a lower interest rate, which is nice, 4.2%. So let's see what we come up with. So what do we have here?
I actually did this calculation. So we are paying a little over almost $141,000 in interest. And that's on top of, our principal and the down payment we already paid. And so our total comes out to $325,685.40. And that is, what we're paying on a house that on the surface cost $200,000.
And that's kind of where that question comes back into play. Is this good debt or is this bad debt? I mean, you purchasing a house, that's probably a good thing that you're purchasing a house. You don't have to pay rent to anyone else. Sooner or later, you'll pay it off and that's going to be your house. So, I mean, there's good and bad debt for sure.
Yes, a home definitely acquires value over time, which it is good. But when it comes to finding loans and determining, do I need this? Is this something I need, like the PS5? That can be something you don't necessarily need, but say you want it and it'll add to your enjoyment of life. Well, then, if you want it and you have the ability to pay back your credit, then definitely, that can be something good as well.
Mm-hmm.
We also have another slide here to kind of wrap up our little activity, showing the different types of credit. So we went over a few. We saw the home mortgage, we saw the car loan, we saw the credit cards. There's also, college loans, which we talked about. There are personal loans. So you're not actually taking it out to buy a specific asset like a home or a car. Those can be for anything. And then you'll see the lenders. It's usually the same 4 lenders that you can typically buy or borrow money from. And then each has their own advantages and disadvantages, why you may want to take out a home loan. Some of the disadvantages of having that mortgage, it's long-term commitment. Taking care of a home, you have to go through extensive credit checks and they may be a little harsher as as far as like credit cards go, they may have higher interest rates versus a home loan, things like that. So there's a bunch of different reasons why and how to take out credit and to use your credit. So it's important to do your research before applying for certain loans.
Yeah, I completely agree. And so we'll go ahead and kind of wrap it up here. We come to our last slide. Do we have any questions, Will?
Yeah, we did get 2 questions in. So on Tuesday, the last, let's see here. Yeah, so the last time we had Fidelity on, they were talking about opportunity cost. So this question has to do to see if this relates at all to the opportunity cost that they learned about on Tuesday.
Okay.
I would say it definitely relates to the opportunity cost. We kind of touched on it earlier where we said when you're paying back your loans or your credit cards, anything like that, you're using money that you're earning today to pay for something that you've already consumed. So when you take out a loan and when you're paying it back, you're using your current income to pay for something that you already have. And that's kind of the opportunity cost. So say you really wanted that PS5 a couple months ago and you bought it on credit. Well, now say the iPhone comes out and you really want that, but you're not able to use the money you're bringing in as income now because you're too busy. You're using that money to pay for the PS5 and to pay off your credit card. So you're not able to buy the iPhone now. And that's kind of the opportunity cost that comes with credit because there's not unlimited credit. There are limits to, how much you can borrow and how much you can spend on like your credit card without paying it back.
Unless you guys become really, really rich and then you guys could get a black card and then there's no limits on that. That could be a bad thing.
And so the black card is a type of credit card with just no limits?
Yeah, there's certain cards out there that give you basically no limits. I mean, but I probably won't ever get one. So
that's awesome. So another student is wondering, what is compound interest?
Yeah. So that compounding interest is kind of what we've been going over when it comes to you paying back that loan. I mean, whenever you're talking investment wise, compounding interest is definitely going to be good for you because the more money you put in and the more money you're saving, you're compounding it, so on and so forth. But when it comes to you paying back a loan, that's really that interest factor where, if you pay off a loan in 10 months compared to 30 months, you're paying less money on that interest there. So that's that compounding part. The longer you have out the loan, the more interest you're paying. And it's just compounding and compounding on that amount.
And on top of that, you have to be aware that the principal amount is what you're paying off, but the interest continues to add on to that. So the longer it takes you to pay it off, the principal, you're still paying interest on whatever you borrowed.
Yeah. Cool. Good
Those
questions.
are great questions.
Yeah. All right. But we'll go ahead and go to our last slide here. And so kind of just want to wrap it up. We talked about a few different things today, and we had some really good questions. Again, if there's any last minute questions, definitely want to hear them. But, we have talked about what credit is. We've talked about how to get credit and what types of credit there are, such as loans, things like that. We went over the advantages and disadvantages with credit. And we also talked about how credit can benefit both parties in the transaction there. So, definitely a good overview for what credit is. And I'm really hoping that you guys, took something out of this and it helped you. Because again, I really wish I had something like this when I was growing up. Even though I heard my parents talking about credit and, don't use your credit card or, all that help that they're trying to give me. It would have been nice learning it in school as well, just a second place. So
Yeah, and even though we work in the industry and it's still a learning experience. I still learn every day, how to work on my credit score or little things, little tips and tricks. It's a learning experience like throughout your whole life. So I encourage you to continue asking those questions, never taking what someone tells you as fact, learn and read everything that you can about this, because it'll only help you and it'll only benefit you in the future.
Yep, I completely agree. And you guys are at that, you guys are in the day and age where we have internet, so you guys can Google an answer, a question, and get an answer right away. So take advantage of your resources. Find things that would benefit you when it comes to learning more about credit, or what would be a good credit card or a good loan for you. Like, use your resources. I promise you guys. The more you know, just the better.
Exactly.
Awesome. Well, thank you both so much for your amazing presentation. I think the kids got a lot out of it. I know we had some classrooms watching, and then of course, just really super engaging. I think it helped. And just to reiterate what you all both just said, getting a jump start on this stuff, is fantastic. It's what gives you a step up and a leg up from everyone else, right?
Yeah.
It's never too early to start learning about what is credit and how to begin to save and how to begin to build and lay those foundation blocks for your future. So a big thank you to Fidelity and Olivia and Cedric, who came here from Fidelity to show us on how to set those ground blocks and those cornerstones. So thank you both so much.
Yeah.
Thank you. It was a pleasure.
Yeah.
All
Thanks
right.
for having us, guys. You guys
Bye,
have a good
everyone.
one.
All right. Take care, you too. And thank you so much to everyone who tuned in today to watch our virtual presentation for our week 2. Just a reminder, we do have, let me get this slide up here. Just as a reminder, we do have Honeywell coming on tomorrow onto our presentation and some other really fun stuff. Your teachers have that link already, but of course you can always visit our website, discoveryfestnm.org, to see a list and the calendar of all the events that we have going on, as well as those live stream links. I think that's all I have. Thanks again, everyone, for tuning in. Stay healthy, stay safe, and we will see you tomorrow. Take care, everyone.